Greetings, it is time for our monthly update on world monetary creation and whether it matches up to the trendline expectation of what we believe the amount of technological deflation per month is at this point in time within the grand scheme of things. So we go to the Yardeni report as we do every month. It is published by Yardeni Research, Dr. Edward Yardeni. This is his phone number and email in case you would like to contact him. And we scroll down. First things first, how much have each of the four major central banks of the world printed? Now, this is not the only money printing in the world. A bunch of smaller central banks, such as the Bank of England, also print money, but these four comprise 85 to 90% of all world printing, sometimes a little more than that. And the red is the US Federal Reserve, and it's not the highest of the four by any means. And that's why when you hear all these bizarre sound bites about how the US Federal Reserve is printing so much that the price of gold will rise, wait, so you're taking the printing of one country that is only about 1/4 of all total printing and saying that will prop up the entirety of a world commodity because gold is priced worldwide. Remember, it's not only the United States that buys gold. And so they just don't even understand what they're talking about. They're acting as though the United States is the only country in the world. And Europe, the blue line, the ECB, European Central Bank, is the one that has done the most printing, $9.6 trillion to date versus $8.3 trillion for the US Federal Reserve. But of course, all printing is borderless, so only the worldwide grand total matters. Even if the United States completely stopped all printing, the other three would print enough to make up the difference. So we go to the cumulative worldwide total as we scroll down here. You know, it started early, 2007, and then the crisis of 2008, 2009 is what induced a lot of quantitative easing. And they keep thinking that QE will stop in the United States. And whenever they do that, there's a market correction and they're forced to start it up again. They don't realize that it's permanent, so they keep thinking they can stop it and unwind it. However, the world total has been rising pretty consistently because whenever the US Federal Reserve makes the mistake of stopping printing, some other central bank in the world comes in and makes up the shortfall. But in 2018, they decided they could stop completely and start to unwind. And they did a tiny bit of unwinding before there was a huge market correction and they were forced to print more. And then, of course, the COVID-19 crisis came and they had to print more, but it got back to the trend line where it was supposed to be. Notice how this is really a smooth exponential curve, which is what you would expect if you read my Atom publication. The amount of technology in the world as a percentage of the total economy continues to rise. Therefore, the amount of technological deflation in the world continues to rise. And the amount of money printing needed to offset that deflation also continues to rise. And while 75 billion a month was more than enough as recently as 2011, in 2021, 400 to 500 billion a month is just the adequate cruising speed. Going much lower than that will actually cause a market correction and too little inflation. And to get aberrantly high inflation, you would have to go to a number much, much higher than that. Now, have we even gone to a number much higher than that? Have we probed the ceiling? To judge that, we go to this next chart, which is the year-over-year annual percentage gain. This is the same data as the previous chart, except that this is the year-over-year annual percentage gain. Now, those of you familiar with my Atom publication know that the annual rate of growth of world printing has to rise by 16 to 24% a year. 16 to 24% a year is the baseline band. Maybe the band is higher than that because when it briefly went above 24% a year, such as in 2020, one could have expected aberrantly high inflation, but that has not really happened. And now the year-over-year growth rate has moderated back down to 15.7%. That's actually slightly below what I describe as the optimal band of 16 to 24% a year. Plus, this high spike was only offsetting this misguided attempt to undo money printing and go into negative growth rate, which, as we know, caused a major market correction in late 2018. And it only keeps the average of the two within this band of 16 to 24% a year. If you took the average growth rate over the 12 years of this chart, you would find something in the high teens, which is in fact in the very band that I recommend. Now that we're down to 15.7%, all these people are saying that, well, all the money printing from COVID will cause hyperinflation, even though the prior 12 years did not see hyperinflation. Maybe this spike was very high. This peak reached 46% year-over-year growth, albeit from a low base of having offset the actual reversal of printing in 2019. But maybe that could have caused an inflation spike. However, that was in February, and now in August, we're down to just 15.7% year-over-year growth in printing. If this is to cause inflation, the time window within which this could actually happen is running out. I mean, if the peak of money printing year over year was in February and we still don't see hyperinflation as of August and in fact September, which we're now in, then it's not going to happen, because the chance of this excess of money causing inflation has a half-life of its own, and after too much time passes, it's just not going to cause inflation, because the velocity of money spike that they need for their scenario to manifest just cannot emerge out of nowhere. It gets spread out over more and more time as the printing gets more and more distant in the past. Now here's another thing to think about, because this lunacy is getting out of control in terms of the Federal Reserve is printing money, therefore the price of gold and other commodities will rise. The same color code as we saw in the first chart in this video applies over here. The US Federal Reserve, the red line, is the lowest of these four. The United States has done about 31% of its annual GDP in money printing. Now, that means over 12 plus years, it has done 31% of its annual GDP. Not its total 12-year GDP, just its GDP of the last year. As you can see, China has done about the same percentage of its GDP in money printing. It could, in fact, do more. The European Union has done much more. It's done about twice as much of its GDP in money printing. So even though they use the example of the Weimar Republic of Germany from a century ago as an example of hyperinflation, the Eurozone, which is the currency bloc that the European Central Bank presides over, is completely dominated by Germany, and Germany is more enthused about money printing than the United States is. It's done twice as much in proportion to its GDP. But all are dwarfed by the country that has done the most, and in fact has done a great service to humanity by calling the bluff of the inflation specter. Japan has done 130% of its GDP. So in proportion to the size of its economy, it's done 4 times as much money printing as the United States. No one says Japan is going to have hyperinflation or even has enough inflation. We've been hearing for 30 years about how Japan has deflation. The reason this much printing still has not halted even deflation in Japan, let alone created high inflation, is because, once again, printing is borderless. When Japan prints a ton of money, a lot of that flows into China, the Eurozone, and the United States, as well as all other countries of the world. Therefore, they can print so much and still not have domestic inflation. That's why you hear this all the time, that the US Federal Reserve is printing money, therefore the price of gold, a worldwide commodity, will somehow rise, as if the United States is the only country in the world, and also as if the United States is the primary contributor to printing. It is not. It does about 1/4 of total world printing, and in proportion to its GDP, it does the lowest of these 4 major central banks. Remember that, and keep showing this video to all sorts of people who keep saying hyperinflation is imminent, or that, well, I saw gasoline at this price, therefore we're living in hyperinflation, while ignoring the other 999 items out of 1,000 that did not rise in price. This narrative is just so misinformed that, I mean, it is a source of endless video content for me, because it's one of the most unsubstantiated beliefs of our age, that we are on the brink of hyperinflation, or in fact already in hyperinflation, as certain formal economists actually think. You know, they're very theoretical. They don't actually look at any real evidence. They can only think in terms of their models, and therefore so much money having been printed must have caused hyperinflation. Even though they don't see any, they believe, well, it must have caused it. The model that I memorized was created in the 1970s, and I had to memorize it perfectly in order to get my PhD. That's why they think that. Now, how much inflation is actually occurring? For that, we go to one of our favorite indices, the Goldman Sachs Commodity Index. And commodity prices are the ultimate measure of inflation because, number one, they're priced worldwide, so they cannot be rigged by any one country. Some people say that their inflation metric in their country is rigged to make inflation appear artificially low. Well, then take the Worldwide Commodity Index. It's full of commodities that actually trade. If you want to buy a barrel of oil or an ounce of gold or a unit of any of the commodities in that index, you can actually do so and measure the price inflation there. It does not include services inflation because wages are a component of those, but those are less pure a metric of inflation because the same people who say services are getting more expensive will at the same time say wages are not rising fast enough, whereas you can't have one without the other. Productivity gains can prevent service price inflation from rising because wages can rise without cost rising due to productivity gains, but that's a topic for another video. So with that, we go to the Goldman Sachs Commodity Index. Now, regular viewers of this channel may notice that I spoke about this just a few days ago, but there's always new people over here. So this is the Goldman Sachs Commodity Index, and over a 10-year horizon, it is almost minus 2%. minus 2%, not even plus 2%, which would be a good number because that's the optimal level of minimal inflation. This is deflation. We all know how oil used to be $110 a barrel and now struggles to get higher than $72 or $73 a barrel. All the people talking about 1 year inflation rates to create headlines are cherry picking a window that suits their narrative. If you take just the 1 year inflationary measure, it shows 48% rise. Wow, that's really high. That must be hyperinflation. But wasn't this an unusually low period? If you take the 10-year chart, it's a little disingenuous to start from here, which is when commodity prices crashed because of the COVID-19 lockdown. You have to take a 10-year window. A minimum 10-year horizon is necessary to assess any inflation rate, no matter what metric that you use. So minus 1.93%. Commodities are actually declining in price. The fact that the US Consumer Price Index is still at plus 2%, as I described in this video up here, is because of services inflation, which is paired with, at least if nothing else, wage increases. Now we need greater productivity gains to keep that low, which are in fact happening, but commodities are the purest and most indisputable measure of inflation because commodities can be traded, their price is not in dispute, and they're worldwide. This whole narrative of how the US government suppresses the CPI by stripping out things that would make it go up is entirely demolished by using the Goldman Sachs Commodity Index to judge whether inflation is occurring or not. And that's why gold also never really rises in price. All the people who advocate buying gold, that's one of the worst investment theses of all time. One, there's not going to be hyperinflation, which is the main reason they're telling everyone to buy gold. Number two, even if there were inflation, gold would not be the thing to buy. The thing to buy would be real estate on leverage or technology equities. But that narrative has become somewhat of a religion because they shut out all evidence that disputes it. These are very intellectually limited and insecure people. Therefore, they want to feel good that they have mastered some multidisciplinary thesis that can make them look smart to people who can't even figure out that much. But they have no idea what they're talking about because just looking at the price performance of gold indicates that was one of the worst investment theses you could do over the last several decades, as I describe in this video over here. And I also make fun of Robert Kiyosaki in this video over here because he says he's been buying gold for the last 50 years. That means he has had terrible returns for the last 50 years. It's really quite comical that he goes around saying that. And it's really a religious belief for a lot of these people. But anyway, that was the money printing update. Only $300 billion of printing done in August 2021. That's a decent amount, but I believe proper cruising speed is an average of 400 to 500 billion a month. Some variation month to month doesn't really matter. And as we get into 2022, that number starts to edge up further because it is exponential. But $300 billion a month, I'd say that is in fact a very modest amount of money printing despite the scary headlines that you see associated with it. Anyway, that was the monthly update of world monetary creation and technological deflation. If you like this type of content, I encourage you to subscribe to this channel. And thank you very much for watching.